Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in this very important webinar on the theme Auditors Communication with Those Charged with Governance, TCWG. As you are all kindly aware that we have organized various webinars as well as VCM on various standards on auditing, as well as we have covered all these standards, as well as we have covered all the line items of the balance sheet, asset side as well as liability side, audit considerations while auditing various assets as well as the liabilities. And today we have chosen this very important topic relating to the auditors communication with TCWG. And we are honored that we are having with us our Honorable Central Council member, as well as the Chairman of Financial Reporting Review Board, Chairman of the Committee on Insolvency and Bankruptcy Code, and Convener of the Center for Audit Quality Directorate, and the Member of Quality Review Board, CA Durgesh Kumar Kabraji, Central Council Member of ICI. So on behalf of AASB of ICI, I welcome you, sir, for acceding to our request for your precious keynote address, sir. So it is my proud privilege to share with you the brief profile of our Honorable Central Council member, as well as the convener of the Center of Audit Quality Directorate. He is a member of various boards as well as the committees in ICI, such as Accounting Standard Board, Auditing and Assurance Standard Board, Board of Studies Academic, Committee for Members in Practice, CLCGC, Professional Development Committee, VSB, Direct Tax Committee, ESB, CMA, DAB, etc. He was also a director of Indian Institute of Insolvency Professionals of ICI. Our Honorable Central Council member CA Durgesh Kumar Kambraji is a senior member having an extensive experience of more than 30 years in company law, corporate restructuring, management advisory, audit and assurance services. An prolific speaker and an expert in law and bankruptcy code, he has addressed more than 180 seminars, forums and conferences on company law, LLP, insolvency and bankruptcy code and standards on auditing. A straight and leader to the core, he has conceptualized implemented many initiatives of WARC during his chairmanship as an active and responsible member of trade industry. He is associated with various social forums as well. So once again, I welcome you, sir, on this platform of virtual platform of AASP. And we are fortunate enough that we are having with us our very learned speaker, CA Ganesh Balakrishnanjit. So on behalf of AASB of ICI, I also welcome you, sir, on this virtual platform of AASB for today's very important webinar. And again, it is my proud privilege to share with you the brief profile of our honorable speaker, Ganesh Balakrishnanjit. Ganesh is the office managing partner of Deloitte Hasking and Sales, Hyderabad office, and is an audit and assurance practice with 3 decades of the experience. Ganeshji heads the talent and learning and development for the South Asia cluster of Deloitte audit function. Ganeshji is a partner of IFRS faculty with the Institute of Chartered Accountants of India for all their in-house and open house programs, and serves as a faculty of Dun and Bradstreet for their programs on IFRS and US GAAP. He is associated with the Quality Review Board and Peer Review Board set up by the Institute of Chartered Accountant of India, the Indian accounting regulator, on technical reviews of the accounting firm. He is a regular faculty of the Board of Studies of ICAI and imparting web-based lectures for the students. He is presently associated with B.R. Ambedkar College and Bhavan's Vivekanand College for review of syllabus of accountancy and commerce. He has undertaken IFRS training for Usmania University faculties. He is an external member of the Board of School of Management Studies of University of Hyderabad. He has presented paper in various forums in India and internationally at universities and other professional bodies to impact of the technology on future of accounting, US GAAP and IFRS. Ganesh is also a motivational speaker and speaks regularly at UGC, HRD, OU, Women's College, OU, and other colleges, university in India. He graduated from Usmania University and is a fellow member of the Institute of Chartered Accountants of India and Cost Accountants of India. He is also a certified public accountant, CPEA, from the American Institute of CPAs. So once again, I welcome you, sir, on behalf of Auditing and Assurance Standard Board of ICI. So without wasting much time, I humbly request our Honorable Central Council member, CA Durgesh Kumar Kabraji, for his keynote address. Over to you, sir.
Thank you, Anil Lalji, from AASB. The respected chairman of AASB in absentia, Sanjeev Singalji, then in absentia Vice Chairman Vishal Doshiji, the speaker for today, Ganesh Balakrishnanjit. I'm sure that the series which have been started by the AASB this year to update the knowledge of our members with respect to the standards on auditing, which is the key matter for all of us. In fact, because of audit and because of accounts, our existence is there. Whereas our focus is on the other subjects, which should have not been there. Our existence is because of the Ministry of, because of the Companies Act, and in the Companies Act, we are termed as the auditor. And when we are termed as the auditor, it is our responsibility to comply with various standards on audit issued by the Institute of Chartered Accountants of India. And friends, let me tell all of you who are there on the virtual platform and listening to all of us that there are 46 standards on auditing which have been issued by the ICAI so far, of which 8 are the various review standards and 38 are the standards, which includes the SQC1, which is the mother standard, I would say. And more importantly, SQC1 is sooner or later will become ASQM, and it will be 1 or 2. Now it is only 1. But since we have to comply with the international standards, then we'll be having 2 more standards, and the number may probably get increased for all of us. But friends, if we understand SQC1 properly, then I'm sure that none of the auditor will fail into its duties, because it says about the various systems to be established in your firm and how to proceed with the audits. And if you have all those systems available in your firm, it is going to make a lot of difference. Today, we are going to discuss with respect to SA 265, which is in connection with the communication of the auditors with those charged with the governance and the management. So friends, it is there internationally also, and almost whatever standards are there internationally, which are pronounced by the IFAC, we are following all these standards as SA in India. And let me tell you that it is of utmost importance for all of us that we follow the standards issued by the ICAI. I would say prepared by the ICAI and approved by the Ministry of Corporate Affairs now, notified by the Ministry of Corporate Affairs. Earlier, it was issued by also us and notified also by us only, but now the things have changed and it is notified by the Ministry of Corporate Affairs. Now, the important thing as far as those charged with governance is concerned, as auditor, what is our responsibility? While we conduct our audit, at the beginning of audit, during the audit, and at the end of audit, wherever it is needed, we need to communicate with those charged with the governance as well as to the management personnel. And not only take the notes from them or in the form of certificate, in the form of written representations, but wherever our dialogue happens with them, we need to make a note of those also. It is very important for all of us. If the case have been selected at QRB, if the case have been selected at FRRB, then what kind of note you are having? On what basis you have taken a particular judgment that this transaction is right, wrong, and you are giving your opinion, or it is EOM, or it is key audit matters, or whatever it may be. But if the proper documentation is not there, it is going to create problem to us. So it is of utmost importance for all of us that we follow SA 265, and not only SA 265, all the standards which are there. Friends, as far as I know, and I have limited knowledge of this, though I am involved into the FRRB as chairman, I am convener of the Center for Audit Quality, where we are taking various initiatives, and the AQMM, which is going to be the mandatory from 1st of April 2023. We are the first in the world to have this audit quality maturity model. We are the only institute in the world who have the matured model for the audit quality. Whereas in the other countries, whether it is developed one or developing one or the best of the institute, they are only having the AQIs, audit quality indicators. So we have compiled those all AQIs, and we created a model out of it that if you are having X number of points, Y number of points, Z number of points, or A number of points, your level of the audit quality of your firm will be so and so, level 1, level 2, level 3, and level 4. And it is going to build the capacity of all the Indian chartered accountancy firm, and probably it will help the international bodies also. Like they have taken our DCMM, they have taken our SRMM, probably the AQMM also, the internationally they will start following. So now the Indian Institute, I would say Institute of Chartered Accountant of India, have started leading from the front rather than only conversing or following the other standards or other international standards. So we are making difference. We are the first to have the forensic standards also in India, forensic accounting standards. This is going to make a lot of difference. We are going to have the valuation standards too. So this is going to give the lot of things. I was just telling, if at all we need to have a dialogue and communication with those charged with governance, then at the beginning, it should be our responsibility to discuss about the planning of the audit, timing of the audit with the management. Then during the audit, we must discuss various significant findings and issues during the audit with the management, have the conclusion, jot down and note down the conclusion with us, because it may be asked by anybody, any regulator in future. And we should also try to find out with respect to the difficulties and disagreement we must, which we have with the management, wherever it is there. These are also required to be noted down in our working paper. If we don't note down all these things, then it may create problem to us. Likewise, at the end of the audit also, I feel that we need to have the management representation letter, and what should be included into MRL, it is listed down and jotted down, and we have the 580 over there, where SA 580, where the implementation guide is also there, and accordingly one can plan it to take that MRL from the management. And whatever they give in writing, beside that, if there is a verbal dialogue with the management, then that is also required to be jotted down by us. We must keep a note of it. Then communication with respect to the internal control, wherever there is a deficiency, there are no deficiency. If we are satisfied with this, And if we are satisfied, then also a note should be there with us. Probably they may think in a different way, you may think in a different way. And if your views are not the same which the management say, and you are satisfied with the management, all these things are to be noted down. Then uncorrected misstatement to the financial statement. If at all it is there, this is also required to be noted down in your things. And material audit adjustment, if it has taken in the financial statement, with respect to that also, there has to be dialogue with the those charged with governance. And also, wherever you feel that there are significant matters which are going to affect the true and fair view of the financial statement, those are required to be discussed. It is noted, it is required to be noted, and you are noting paper and will make a lot of difference. So friends, I'm sure that whenever you conduct the audit, so what kind of discussion is required to take place with those charged with governance, I think in detail today Ganesh Balakrishnan will be discussing with all of you. And he is a person from a firm and having the vast experience in the audit. I think he'll be the right person to tell you that what kind of documentation is required to be maintained and in which way when you are discussing and communicating with those charged with governance. So with this, I welcome you all to this webinar organized by AASB, and also I thank you all for giving me a patient listening, as well as I thank the AASB for giving me an opportunity to interact with all the members virtually. Thank you all. You are on mute, Anilji.
Thank you so much, sir. Thank you so much for your words of wisdom. In a very short time span of 15 minutes, you have covered a gist of complete SA 260R and SA 265, and you have covered with the audit quality maturity model, audit quality indicators, and all the audit aspects which are required for auditing of the financial statements. From the core of my heart, and as well as on behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time, sir. Thank you so much, sir. Thank you so much for your words of wisdom, sir. Sir, if you permit, can we start our technical session, sir?
Please, please.
Yes, sir. So now we are having with us our learned speaker, CA Ganesh Balakrishnanjit. May I request Ganesh, sir, to please start his deliberation, sir. Over to Ganesh, sir, please.
Thank you very much, Lalji, and thank you so much, Mr. Durgesh. I think you have set the context today. I think it's very relevant, and I'll say why it's very important. All the while, so far, we have been only talking about completing an audit, issuing an audit report. Now it is important for all of us to think that whatever we have done, have we communicated appropriately to those charged with governance? And I think I'll tell you why this is very important. We always refer to those charged with governance, basically nothing but your board of directors or an audit committee, because that becomes a subcommittee of the board. But two relevant points Mr. Durgesh had raised, very, very relevant given the context of the audit quality maturity model, which is effective 1st of April 2023. There is a scoring pattern that will be required, whether it is a practice management or if it is a human resources management or a strategic or a functional management. There are scoring points, and that forms the basis of how maturity of the firm is matured in terms of establishing the best of the practices. And there are various scores that are given in terms of the possible points. And one of this important aspect of it, which is covered, those charged with governance, is in respect of the practice management operations, whether the audit firm had communicated to those charged with governance. Now, I'll tell you why these are very, very important and how we need to relate to in a day-to-day communications. Audit committees, let's spread this between communication with those with our listed companies, large companies, and those which are private companies and other companies. Typically, what happens is in respect of those which are listed, there is this corporate governance model that works, and therefore you are more focused on listed companies. Then you have something on Companies Act, which also establishes the manner in which a corporate governance has to be there. So you have category 1, which is listed, category 2, which are driven by the Companies Act, and the third one, which is basically your private limited companies, which is more closely held. Now, when we communicate to those charges, and what are the auditor's response? If you really look at from an auditor's life cycle of performing an audit, the life cycle of performing an audit right from the time of appointment is actually driven by the board of directors. Whilst the management would call for the tendering, whilst the losing, the most of these discussions happen with those charged with governance or the board of directors, and they elect or select the auditors who would be the auditors of the entity that they're going to audit. Some might say, hey, listen, this already could have been done by the promoters and therefore board of directors would. Now, in the change scenario that is happening, and where given that the NEFRA is looking at much more closely in terms of what do we do, and when Mr. Kabraji talked about 46 standards, these 46 standards are mandatory standards. These are auditing standards which are mandatory. And therefore, every standard is viewed by the NEFRA very closely when we perform an audit. So whether it's an SQC, which is now getting into what is called an ISQM called the ASQM, the Standards on Quality Management. So therefore, I'm monitoring standards of quality management monitoring. Now, if you look at all of these aspects of it, it only draws one reference, that whilst the auditor would carry out an audit, but when they talk about what is the process that they have followed, what are the things that they've looked at it, and how they have went about the audit for issuing a report, whether it's an unmodified report under SA 700 or a modified report under SA 705 or 706 with the EO emphasis of matter, the process of audit and how you have arrived at an opinion is what you will start talking about with those charged with them. I think what is important for all of us is to understand, it's not that the auditors alone would be involved to present to the board of directors and say, hey, listen, this is what we have carried out. It's the other way around. This is what is called as two-way of communications. Now, given that if you have seen the recent CARO 2020 requires a lot of these disclosures, and many of the disclosure, for instance, on fixed assets, there is safeguarding of fixed assets, the responsibility under the Companies Act of the board of directors. Now, if you were to look at and comment whether the title dates are not there or not there, how do you communicate to those charges? That's number one. Mr. Kabraji talked about something related to uncorrected misstatements or material adjustments, or if it relates to significant estimates and judgments that gets into it. When I talk about significant estimates and judgment, whether it's a useful life, whether it's how do you make a provision for doubtful debts, when do you recognize revenue, what point in time, when do you capitalize, all of these are judgments. Now, under section 134(5)(e) of the Companies Act, the board of directors are required to lay down all of these, including accounting principles, internal controls, operative effectiveness, various other aspects of it. Now, we being the auditor, when we carry out an audit on the books which is maintained by the management, and then report, because this is a report which has to be approved by the board and then will be adopted by the shareholders. Between this, the communication with board of directors or those charged with governance or the audit committee becomes critical. So far, we have not been focusing on this aspect of it. I think time for all of us, whether it is a listed company, whether it's a large limited companies or a private company, please ensure that for all the work that you have carried out, there is a document that prepares, that brings about the scoping, that brings about the areas that have been planned, that brings about your opinion, that brings about the various issues, judgments that have gone through all of these, and therefore it becomes a document that you have conversed with those charged with governance. I'll tell you why this is important. Because tomorrow, whilst our audit work papers in the form of a documentation, SA 230, will talk about for all the works that is carried out, or an SQC, when one which talks about the process of acceptance, monitoring, ethics, independence, and all of this, summed together, is what you will drive it as an auditor's communication with those chartered accountants. So the first one where I'm going to talk to you about is SA 260. That is our auditor's communication. The second one, which is very critical, is SA 265, the deficiencies that you identify during a verification on internal control. And I think this is very, very important. I think if any organization has got an effective internal control, then there is a very less likelihood of any fraud or a misstatement, because this is a very important aspect. If the controls are operating in the manner in which it should have operated, and that all of those deficiencies have been remediated on a timely basis, then there is a very less likelihood of any fraud being identified or committed during this process. I think this is a very important statement. Internal control of financial reporting has been in the play for long. While it is mandatory for the board of directors to have an operative effectiveness as far as the IFC is concerned for listed companies, it is only the adequacy which is required for other than listed companies. But for the auditors, it is incumbent that you need to include both for listed as well as for the unlisted companies or for the private. I think other than those which fall under the exemptions, other companies would get covered. So therefore, what we should start doing it, at what point do we communicate with those charged with governance? What are the matters that we need to communicate with those charged with governance? How important is for the auditors to identify and discuss whether it's an audit committee chairman or it's a board or it's accumulation of a board. If we don't have an audit committee, what are the things that we need to define is what I'm going to talk in the next 1 hour or so, and then thereafter I will ask for any questions and answers that may follow through. So SA 260 predominantly talks about communication with those charged with governance, and I think what's important is communication. Communication, in fact, Mr. Kapra talked about the important aspect of that if you communicate, it's not oral communication. Whatever you have communicated has to be documented or minuted in your work paper. And I think this is the most important aspect of it, which we should not miss. We should bring out the date in which a meeting was set up, what is the points of agenda for discussions, what are the nature of discussions, what are the summary of discussions and minutes, and then forms part of the work paper. And if there are anything that you need to look at based on the discussions with the board, those charged with governance, then you may want to put the relevant work papers which will drive it. So communication is a very, very critical aspect of it. If you don't communicate, you can communicate through oral or verbal, you can communicate through presentation. But what is important in a presentation, at least you have all of this information in a single deck, and therefore it is easier for you to relate to as to what you've spoken. But if you've done through a verbal or an orally, I think the minutes is what would become the, what do you talk about? Predominantly, you talk about the financial statement of audit, you talk about the planned scope, you talk about the timing of audit, the areas of interest. If it is a listed company, the key audit matter, the procedure that you would follow, how do you send out your confirmations? All of these will feature in form of a deck when you talk with at the planning stage. And when do you do the planning? Do you do the planning at the beginning of the year? Do you do the planning at the half year or the 9 months or at the closer to the year? Typically, when you do an audit planning, the planning is where you have substantial of the information about the operations, about the financials, about how the business would be in the next couple of months on which you are going to issue an audit. For that purposes, what you will do is you may then identify, because again, this planning is not the same as you've done in the past, because there could have been changes in the business model, there could be changes in the events. For instance, what you'd have done in pre-COVID period is different from the post-COVID period. It is still different from the period that we may be auditing in the year 2022. So therefore, the communication, the manner in which we do it, probably today we are talking about a virtual learning process. Probably in the past, we were always used to have mostly through what is called a live seminar. So therefore, you need to look at from that perspective as If there are changes, how do you going to determine these changes? Given this technology is taking a major role in the manner in which we do audit, I think we also need to look at the IT securities, the data integrity checks, all of that will be forming part of your communication with those charged with governance. Now, this is one where you communicate. The other is obtain, if there are any information from those charged with governance, as to what are the things which in the eyes or in the views of the board that they would want the auditor to discuss and implement or look at it as an area. For instance, a board committee member might say, or an audit committee chairman might say, hey, listen, these are the changes that have come through because of the recent changes in revenue standard or in changes that have come up in the financial instruments. How does this impact the company? Or, for instance, recently we talk about the ESG. When we talk about the environment, social, and governance, how does this impact the company? So let's say this is sort of an information that is given. Now you need to think through, again, these are not something which is forming part of your audit plan, but this is something which the board might say, hey, listen, this is what I want you to look at it. Whilst this may not be mandatory today, but this is something which I would want you to look at it from that perspective. So this is called obtaining. One is communication, the other is obtaining. Then is providing. Now, how do you provide this? You can set up, if you are a listed company, you can set up a quarterly calls. You can have a pre-audit committee calls, or you can have a calls post of your interim reviews. Or if you are in other companies, you might set up, say, listen, I want to set up something in the month of January because it is closer to the month of March because substantial period has lapsed. And therefore, I may start looking at what period in time. So therefore, if you were to look at it from a listed companies, from a listed company perspective, you may provide your observations based upon, let's say, if it's a review or if it's an audit. If it's a monthly audit or a quarterly audit, you might talk about what are the significant or relevant observations arising from your audit process. And that is what becomes very, very critical. For instance, let's say if the labor code gets implemented, how does this labor social security code or labor code could impact the company, could impact the payroll, could impact the manner in which you will have to provide for the retirement benefits. So you could have all of these coming as a part of the process. So therefore, if you have any such information which you would want to discuss at regular interval basis, you can do it. It is not a listed company. It is not information that is available. Probably what you can do, you might want to have a discussion with those charged with governance closer to the year end, and then say, hey, listen, this is what has been our experience in the past. This is what is our understanding based upon the recent financial information or trial balance that is available. This is what we propose to plan and do. These were the observation in the past, and this is what we think would be significant, which we want to do. We want to look at it or focus on. Now, this way, that means communication is a two-way street. It is just not one way. It is not saying that I have given the report, I have provided the information, and therefore it's a responsibility of the board of those charged with governance. No, it is a communication which says the end objective is because the board approves your accounts, the auditors audits the financial statements and books of accounts, and therefore any matter that has an impact on the financial item, on the control deficiencies, or any other matter, the board should be aware of it and the board should concur on it. If there is a difference of opinion, and that is how it gets covered as a part of the management letter. That is where you have in a management representation letter what Mr. Durgesh talked about, the uncorrected financial statement, the material audit adjustments, the significant matters. All of these, suppose if you have an uncorrected mistake, had you corrected this misstatement, how does the financial statement look like? That should form part of the representation letter, or that should form part of the communication that you do with those charged with governance. I think this is a very important aspect of it in relation to that. So who are these people? You might say those charged with governance, sir, there are no independent directors, the private companies does not. So it is a combination of those, which requires whether there could be independent directors, or it could be the people who are required to look at the strategic decision of the entity. Their whole responsibility is the overseeing of financial reporting process. So therefore, if you have a board which are not involved in the day-to-day operations, therefore they could become the governance board. So therefore, from that perspective, you could look at it. You may also have in that board some of the management personnel who also enjoy, like a CEO, a COO, also could be a part of the governance board. But together is what they will become, what is called those charged with governance. The only issue that can come up, you might ask a question, sir, everything is related, the directors are relatives, and therefore how does it become different? I think the law requires you to be, you have to segregate this. You have to segregate people who are executive, who are non-executive. So therefore, if you look at any of the composition of a board, it talks about executive, non-executive, independent, non-independent, and the manner in which you need to have the holding of directorship. That means how much of should be, if you have an executive, how much should be the independent directors or the non-executive directors. All of these are governed under the rules of corporate governance. So therefore, it is important that when you look at even the governance structure or the board structure, this is a focus point that you need to do. But it's also important for us to understand that once a board is established, it's our responsibility to have a two-way street communications. Why this is important? Why is this a two-way communication is very, very important? One, it gives you the objectivity. It gives you the independence. It gives you the confidence that you can go and talk to someone who will listen and get these issues addressed. If you do not have someone other than the management, then the challenges that you would face to get the audit completed and approved, and still the deficiency could continue for a larger period in time. I think from that perspective, it is important that you need to look at someone who understands the language of what the auditor is speaking, should understand from a perspective of what is relevant when you're in relation to the financial statement audit. I think this is a very critical aspect of it, because if you have a strong governance, then the risk of material misstatements of financial statements, or if it is relating to internal controls, all of these would have been more effective. If you do not have a very good governance model, there is a likelihood that such weaknesses may continue. Somebody might say, sir, this is only a two directors company. How do we make sure this is there? Therefore, what is important is the biggest tool which the auditing standards talks about to you is issuance of a management letter. A management letter should be the basis in which you should discuss about the areas, you should discuss about the deficiency, you should discuss about improvements and all of them. I think this is a manner, if you have two directors, your management letter will form the basis. This is different from the internal control deficiency that we talk about in SA 265. What I'm talking about is in the event that if the directorship is very lean, and it's it's important for us to make sure that we communicate those which are relevant. Somebody might say, sir, the fees that is paid is very, very less. What is the point of communicating? It's the same thing. The fundamental responsibility of an auditor in respect of those charged with governance is that we expect the board to be independent when it comes to approval of the accounts, and we are independent auditors on which we comment on the financial statement. Together is how this communication and the manner in which the results are disclosed. Now, what's important is it's also very critical for the auditors to have this engagement with those charged with governance, identify people. It's not always possible that you might mark everybody in the mail and say, hey, listen, I want to tell everybody in the world that I've done this audit, these are the deficiency, I don't know what is happening. No, you need to identify if there are appropriate person with whom you can have a dialogue on a continuous basis. And I think this is a very important aspect of it. I'll tell you why this is Very important. When the sailing is smooth, there is nothing which happens to you. When the weather goes rough, that's where all calamities starts falling on you. And at that point in time, who is the saving grace? Is a grace that you would have those issues discussed with the board charged with governance, or the board of directors, or the audit committee, whoever it is, the subgroup which the governance believes that they should deal with the audit. For a listed company, they might say, hey, listen, this is a group which is the audit committee group, or a risk and compliance committee group. These are the people who will discuss with the auditors in terms of the internal controls, in terms of the financial statements. Probably you will look at that aspect of it. This is a very important aspect of it, and I'm telling you, re-emphasizing this. Please do not let go this advantage of having a tool that is available with the auditors when it comes to communicating with those charged with governance, and it's a very critical aspect of it. Now, what are the matters that you need to include it? I think let's focus on this. What are the matters? We are talking about a financial statement audit. So when we talk about a financial statement audit, what are we generally giving? We are forming and expressing an opinion. Now, opinion on what? Opinion on the financial statements prepared by the management. Who reviews this? Who reviews the budget? Who approves the budget? Who looks at each of the line items? Who discusses the variances, alliances, analysis? Who discusses the manner of the entire audit process? Who discusses about the growth? Who discusses about the dividend policy? It is the oversight of the governance. And therefore, it is important that when we are doing an audit of the financial statement, it's this important that we discuss in relation to our responsibilities, our scope, our methodology, our planned procedures, our observations, our conclusions, the representations which are given by the management. Together is what becomes a particular discussion tool with those charged with governance. Now, the planning and time scope and timing of audit, it has to be as comprehensive as it should be. It cannot be saying that we have discussed the planning and scope of this thing, timing of audit, we'll carry out the audit for this thing, we'll cover areas of fixed assets, inventory, investments, current assets, in all of this. No, you have to go back and say, hey, listen, this is our materiality. First of all, you will start, this is the materiality. You might go back and say, hey, listen, these are the areas which we believe in our view is a key audit matter. Or we might go back and say, hey, listen, this is what we believe is a significant risk area. We might say, hey, listen, revenues are not recorded on a timely basis. I might say it is a transfer of title does not happen, or the control does not pass to the customer. So therefore, I might say cutoff could be one of the issues. Or I might say this is a commodity market, and therefore I may provide a lot of these discounts, and therefore discounts could be one significant matter. So therefore, we need to identify what is the risk that the auditors have got when they're conducting an audit, and how do you discuss the significant risk? There are two risks that you need to discuss. One risk is what is called as a significant risk that impacts the opinion, that impacts the areas that the auditors should focus, which is very good. And the second risk is a fraud risk, which is associated with it. Fraud risk is basically nothing but your management override of controls. So these aspects of it is what you would need to discuss with those charged with governance. I think this is a very critical aspect of it. You cannot say that you have not discussed. You might say, I have discussed with those charged on fraud. What did you discuss? What is the methodology you followed? With whom did you interact? How independent are those people? What are the types of questions you've asked? What is the information that is available internally? What are the information available externally? How have you evaluated all of this? How are you reviewing those types of entries, that whether it's a cash, bank, or a journal entry? Who is approving? Who is authorizing it? Who is preparing it? What point in time they are doing it? All of these factors have to form part of your discussions with those charges. See, that those charged with governance, while you might prepare a document which is very, very skeletal, but it's important, equally important, that when you deal with this, you need to be specific in relation to the areas. You should be specific in the areas that you're performing. You should be specific in the issues that you're focused and would want warrant. For instance, There are goodwills that are sitting in this, or there are intangibles with that on the balance sheet. You may want to look at it to see whether there is an impairment, at what point in time the impairment takes place. When does the management prepare the impairment analysis? What are the budgets that are being used to test these impairments? All of these aspects of it, the nature, scope, timing, and the extent is what you need to do. For instance, when are you going to send the confirmation of balances? When are you going to observe inventory? When are you going to test the property, plant, and equipment? When are you going to look at certain aspects relating to related party transactions? What are the things that you will be looking at, the changes that could have an impact because of the changes in Companies Act? You could talk about Rule 11E and F that got introduced, or the CARO 2022 that could have an impact. All of these is what you will need to discuss with those charged with governance. For instance, you might have saying that, sir, the stock statements that are for a private companies are not prepared on a quarterly basis because you don't have a financial closing. How do you comment on that, that the books of accounts and information that's provided to the bank are the same? So these are some things that you need to start thinking about it and discussing with those charged with governance. In a listed companies, it's much more robust. It will talk about the engagement team. It talks about the teams. For instance, does it use a specialist? Does it use a tax? Does it use an information technology specialist? Or does it use any other experienced personnel on this engagement? Who would be the engagement quality control reviewer? Who are the people who are? All of these are what is looked at it from a perspective of a listed company. And a listed company is also required because when you're today talking about Section 144 of the Companies Act, when you're talking about what are the areas of work which the auditors in a listed company cannot carry out. If you cannot carry out, you need to bring about those aspects of it. Therefore, any firm, the network firms, the independents, the judgment, all and the fees between both the audit total fees and the non-audit firms within the network firms, all of these you need to bring in, because one of the aspects that are being coming up and which is in a discussion is in respect of whether there's an independence impairment. If I carry out a taxation work, if you carry out a due diligence work, if you carry out any other advisory work along with the audit, does it impair my independence? If it is a listed company, while the law today is not so much clear in terms of what can be done, what it all talks about restriction of the fees, but it's important equally to understand that the independence is the state of mind, is a practice that you follow rather than what is written in the book. And therefore, when you as an auditor go back and say, listen, I am the auditor who is independent. This is what it is. This is what we have transaction with the network firm. These are the personals who have been used from the network firms. All of these should be discussed with those charged with them. So the auditor's independence is a very critical aspect of it, which need to look at it. Now, I've talked about time establishing communication process, forms of communications and adequacy. It is important for all of us to understand how do we assess the risk of material mistake. Now, let's look at it. Now, if the company has got a perpetual inventory and the company carries out inventory of verifications on a quarterly basis, the risk of material misstatement due to shortages is lower because there is a continuous process. Now, let's take a case of a company which does not carry out stock verifications, maintains stock verification, stock statements in an Excel sheet, or does not maintain the stock records and says whatever is available in physical is my stock statement. Will my risk of material misstatement be high or low? In this case, it will be higher because the books and records are not agreeing to what is as per physical, or the physical is not agreeing to what is as per the books. And therefore, it becomes, you have to evaluate as an auditor whether you have got sufficient appropriate audit evidence. And if you do not have sufficient appropriate evidence, an Excel sheet is prone for errors. An Excel sheet is a case of where a lot of fraud things can happen. And if you don't have the basic books and records, you could have a potential of excess inventory being shown without being recorded in the books. And therefore, this is important for the auditors that when they communicate on the risk of material statement or in respect of information that has to be received from the entity, whether you are in a position to carry out an audit in accordance with the law, in accordance with the standards on auditing, and the firm is in a position to obtain sufficient appropriate audit evidence wherever it is required. Suppose the company says, prohibits you from sending confirmation, says that you will not get confirmation, and therefore you have all of this and say you do alternative procedures. I think that's where your risk of material misstatements have to be revisited and evaluated. Now, what is important? You may do everything, but if you do not document, that becomes a significant issue. Where there are matters that are required by standards on standards on auditing to be communicated orally, the auditor shall document every aspect of it, what has been communicated, and shall retain as a part of the documentation. And this is a very, very critical aspect of it when it comes to oral communication. Written communication is fine, but when it is oral communication, make sure that you document in whatever you have discussed as a part of the minutes, and the minutes you can share it as a copy with those charged with governance, as well as be a form part of what is called as your audit documentation. So what is the role of communication? So there are certain other information that is very, very important. Now, from a relationship perspective, you need to establish a constructive working relationship. And I think constructive relationship is not that, board of directors says, hey, see, whatever is possible, the client needs some help, you see a way out, this is how you should look at it. The moment any director says, please look at it and find a way out, the independence gets automatically disturbed. So the impairment of an independence, even from a director perspective, is as much as important as much as we believe that we are independent and therefore we issue an independent auditor's report. It is critical for us to establish this relationship. You should talk about what is law. Maybe if I go to a client and say, this is what the law, he says, I know the law, you tell me a way out. You may run into these problems. But I think what is important is state the facts before those charged with governance. Tell these are the facts and ask the board of directors to respond. You might come back to me and say, sir, we have discussed, but the board of directors do not really respond relating to it. You may come across a situations where the board of directors or those charged with governance will say, listen, I don't understand your accounting standards. I don't understand your auditing standards. You tell me whether this financial statement is a true and fair view. That's all I'm interested in. Because the board of director or those charged with governance will always look at from his perspective, what is my risk? If I say I understand everything, you might come back and say, listen, you have understood everything and therefore you are also equally responsible. He says, no, my understanding is limited to say, if I have to approve this financial statement, does this financial statement give a true and fair view? That's all I'm trying to understand from you. And he will ask you a straightforward question. To avoid those type of conversations, if you have conversation interactions on a regular basis, that is where you will be able to get more and more insights from those charged with governance, or help those charged with governance to even look at it from a perspective, is there something that I have to do it from that governance perspective? I think this is a very important aspect of, in fact, if you go back and tell the board and say, listen, either you listen to me or you understand, or I'll qualify the report. The easiest way is to qualify a report. But does that qualification make sure that you are out of the responsibility as an auditor? Does it absolve you from a responsibility as an auditor? The answer is no. Still you are responsible because you had every such information which you are supposed to required to report. And this is where the board of directors or those charged with governance will help you in making sure that these issues are discussed and these issues are documented. it is clear communication with those specific matters is an integral part of the audit. And therefore, you will have to take that extra step to talk about the procedures or talk about issues, talk about how it's there. Not every time the conversations are very, very smooth. The conversation will not be expected smooth when you start questioning even the manner in which these accountings are done. You may have brickbats from them. They may also threaten that if you don't sign, I have somebody else to sign. But point which is very important for all of us is to understand the changing regulations. No longer we can go back and say, listen, I told them, they did not listen. No, the answer is no. The point is, if you have now today ways of communication, the ways of representing issues. And if you have not opted for this, you have only opted for this, you are actually failing in your duty as an auditor. So therefore, it is important. The communication with those charged with governance is a critical aspect. At times, there could be certain restrictions in which you want to communicate, which you can't communicate. So for instance, you may not like to share any information which is outside of India. Let's say yours is a listed company. They've got a parent company gets the entire information. You may be prohibited in sort of communication. So, or for instance, there could be instances where an investigation is getting carried out or something which is not appropriate or illegal. In those situations itself, you may have to look at it from a perspective of obtaining legal advice. For instance, there are disputes with promoters. There are allegations about fraud by one of the promoters, or there are allegations by those minority shareholders, small shareholders, to say there is the governance is a challenge. You may start looking at from a legal perspective, because you as an auditor, your responsibilities, though under the other legal regulatory reporting responsibilities, you have got this reporting, which is now coming as part of this, as part of your reporting. It is important for all of us to understand from SA 250, or for that matter from the changes on NOCLAR that is coming through, that if at all there are matters which could impact, you might seek a legal advice, and a legal advice is a very critical aspect. Why this is important is, don't take legal advice for everything and anything. Let's say there is a dispute, there is something, an arbitration is happening, the arbitration proceeding has gone through, or an income tax proceeding assisting has gone through, you've got similar set of pronouncement that has happened. You may want to look at it from a perspective, whether does it impact, whether it's material on the financial statement, does it require a disclosure, is it a disclosure deficiency, or you may want to refer to a legal counsel and say, listen, I want to understand more about it. Maybe in today's world, no legal counsel will give you everything all the time. He might still give you what the management wants, but it's important for you to understand, appreciate how, if there are any such restrictions. Every structure, governance structure will undergo change. Those with listed companies could have maximum number of independent directors. Those with unlisted companies could have, or limited companies could have different structures. Those which have got holding company, they could have a different structure of those which charge with governance. So it is, each one would be different, and therefore this characteristics of who is the appropriate governance is decided at the board and approved by the shareholders. But remember one thing, the structure is also very, very important. Even if you're conducting an audit committee, and if the audit committee requires independent directors to be there, and if they are not there, it is your duty as an auditor to go and raise. You might say this is a secretarial work, I don't want to look at it. So these are some things which you need to look at. But there are also certain situations with those charged with governance. Let's say you have got uncomfortable discussions with those with the senior management, and maybe they may be involved in certain activities which you believe are not appropriate. So you may want to have a discussion with those charged with governance. I think one of the aspects which right now it's not mandatory, but I would say it should make it mandatory, is an in-camera meeting with those charged with governance, and help them explain that the management is, when the managements are not there, in camera you explain what are the challenges and how you are dealing with those challenges. It could be receiving of information, it could be cases against where you believe there could be some inappropriation, or their misappropriation, or you might believe there are certain frauds or improper payments that could have been done. I think these are some things which are very, very critical, and that's where your discussion with those charged with governance assumes importance. You may also have a subgroup. That's what I'm talking about. You could have a main group, or you could have a subgroup. Whether it is a subgroup or a main group, it's important that all informations are discussed with everybody who's concerned. Now, other aspect of it who are involving in managing the entity. Now, this is something which is very, very important. When you have the management, which is a closely held companies, how do you deal with those? I think what's important for all of us, and I'm going back based upon the experience. In many of the startup companies that you might be doing a lot of these unicorn companies, you might be doing a lot of these private companies who have got investments. While it is a private company, it's also important for you to understand if there is a shareholders agreement which is there, you need to look at very closely if there are any issues that could have an impact on the auditor's performance. And I think why this is important. We have seen cases in the past, and also even some of the cases which Mr. Durgesh would be able to talk about it. I think you need to look at it from a perspective that when there are two people who are fighting, the easiest target is the auditor. So I think even it's as much as for a listed company, we may put a lot of focus from a shareholders or a third party or the small shareholders. In a small company which has with two shareholders with PE investment, you may have an issue with one of the PEs may not be doing appropriately, which you think. I think that is the point where you need to draw as to what you would want to communicate. I think communication becomes very, very critical. And I think this aspect of it is what you need to look at very, very closely. So therefore, it is not as much as you're responsible for listed companies, for closely held companies, it is equally important that the responsibility for you as an auditor is to bring out those issues which the other person may not be aware of. And I think that's a critical aspect of it. Now, what are the auditor's responsibility when it relates to the financial statements audit? Now, we write an entire paragraph about what is the auditor's responsibility. We might say we have audited, this is the balance sheet, this is the statements of profit and loss, this is the state changes in equities, a statement of equity, this is the cash flow, this is the notes to accounts. We have complied with the ethical requirements of ICI. We have ensured that it's based on how there's nothing which your attention is it's free from fraud or material misstatement. You may write an entire story in your auditor's report, in our auditor's report. I won't say yours, it's our auditor's report. But the fact is very important, is financial statements free of material misstatement due to fraud or error. And this is where also the CARO is coming back in terms of 143.12 if there are any reporting requirements. These two aspects of it becomes much more onerous on the auditors to look at it much more closely and clearly. We need to get, and the most important thing which we normally don't give importance is a written engagement letter. Many times we'll say, anyway, they've appointed, what is the point of having an engagement letter? Anyway, we have agreed, we have signed, everything's fine. Engagement letter will bring about what is the role of the statutory auditor. Is he auditing financial statement audit of a parent company? Is he auditing a standalone entity? Is he auditing a consolidated entity? Is he auditing any other? Is he providing any other tax services? What is his role? What is the responsibility? What is expected of the auditors? What is expected of the management? What are the limitations? And all of this has to be given in writing. This is a very important. Never ever miss out on the engagement letter. Engagement letter is a very critical aspect of it. The second aspect of it, which is important, is you don't have to go and talk about how did you design your audit, what did you get? No. All you have to talk about is, if this is the planning that you have done, what are your results arising out of that plan? And that is what you need to start looking at and communicate. Because when you're expressing an opinion, you're looking at significant matters. You are looking at items that are relevant when it comes to reporting with those charged with. This is a very critical aspect. I think it is important for each one of us to spend that little time and explain to those charged with governance, this is what we have done. This is my auditor's report. Don't just say our auditor report is an unmodified report, and if you've got any questions, come back. No. Go to the specific paragraph and say, this is what we have written, this is what we have done, this is what we have carried out, this is what is our opinion. These are some of the exceptions which we have considered when we have issued this opinion. It's a very, very relevant point. Because those charged with governance will say, anyway, you have issued an unmodified opinion, what's the point? But that is not the way one should look at it. You should look at it much more closely and look at that each area that you have looked at and how does it impact. You may have an emphasis of matter. You might have saying that you have examined something in relation to the transactions with loans and advances with third parties or even with subsidiaries and all of that and the end use of it. You may talk about dividends, you may talk about various aspects. So therefore, when you're looking at all of these, please describe it as a part of the discussions. Planning and scope and timing of audits, very, very important. Again, I'm reiterating, you have to talk about the significant risk of material misstatement, whether due to fraud or error. Your approach to the internal control. I think we have lost the understanding of internal control. Internal control is not a document which is prepared by the management for the purposes of a report. It has to be as detailed as it should be. It should have a risk control map. It should have standard operating procedures. It should have all assertions, whether it's a valuation, whether it's an occurrence, whether it's a completeness. Every assertion should be there, whether it's a line item, whether it's a item which is a compensating, whether it's a full controls are operating effectively, if there are any partial controls, whether there are any compensating controls, all of these have to be documented and have to be tested independently. It is not that management says, you prepare the internal control, you please look at it and you please sign it. No, because the internal controls have to be divided between operations, divided between financial reportings. Financial reportings could have cycle controls, could have process controls, could have information relating to closing, financial closing reporting process, could have areas on procurement or purchases, could have on sales, could have on payroll, could have on fixed assets, could have treasury, could have anything. How is the control operating? If you have to process one single person on a payroll, what is the input? Is it timesheets? Is it attendance record? It is a punching? Is it something which is maintained by the security? What is the document? How do you establish the person attended the work? Did he apply any leave? Was there any records which is available? How is there an input output in terms of from a system? What? So the process is input, process, output, and the controls surrounding all of this is what is important when you talk about internal controls. Internal controls, you might say, I've used a SCOSO framework. This is what the controls are. These are the control objectives. This is how you look at it. This is how you have communicated. This is what your information secured. The whole objective is how did you determine an internal control, which is relevant for the audit. If the controls are manual controls, the controls are automated controls, are the controls partial controls, partially automated, partially manual. How does this work? For instance, I might test an existence of a fixed asset or property, plant and equipment in terms through the invoices. Or I might test an existence to get this information through what is called the commissioning date or commissioning certificate. Alternatively, I may not have this information. I may say, let me do a physical verification and get that information. All of these gets covered as a part of this aspect. So therefore, it is important that the internal control focus as much as on the financial statement audit. Please focus on the internal controls, which are very, very critical. The maker-checker controls, the duplications, segregation of duties, conflicts, all of these becomes very, very important, and the concept of materiality, which is required to discuss. Now, every financial statements that is prepared is got based upon the lot of accounting estimates that are used, lot of judgments that are used in framing such accounting policies, and the financial statement disclosure. You will have to bring about each of these aspects of it, which should be discussed. What, for instance, you might have transactions with, let's say, in Russia, due to Ukraine war, it might get impacted. So there are business conditions that might be affecting the entity. Or for instance, you're operating in level because of this changing in environment due to climatic changes, there is significant flooding. And therefore the entire operations have come to a standstill. Everything is like, let's say it's pounding, let's say in Pakistan, which happened very recently, everything is pounded. Or an avalanche which happened very recently in Uttarakhand. If you have businesses there, if it has got that disruption, how did you address arising due to risk of it? Or there could be a fire. Or for what could have happened, that all of your products that are produced is no longer is being sold. There are a lot of returns. How does this business conditions affect the entity? Two, if there are any consultations that have been done, there are accounting positions that are, for instance, let's say I'm dealing with a pharma company. I may have got what are called chargebacks. A chargebacks are basically what I say is, I'll pay you at a different rate, you'll take it at this level. But if you sell beyond this, I will give you a profit sharing plan. So therefore, I might say, the agent will say, listen, I will sell this, but this is the over and above profits. So this is the profit share that I do it. How do you arrive at it? Revenue recognition is not so simple. Revenue recognition is not those 5 conditions that you look at in case 115. It's not about a contract, it's not about delivery, it's not about performance obligations, it's not about price, transaction price, it is not about when you're recognizing this. It's about how did you arrive at that number? To say this is the amount that I have to charge you as chargeback. How did I arrive at the royalty amount? How did I arrive at the impairment analysis? What are the inputs that have gone into it? Becomes an issue of accounting or an auditing matter. For instance, you have been prohibited to carry out inventory verification at a particular location because it is based in Naxal area. You can't go, and let's say in some parts of very, very extreme parts of Madhya Pradesh or Jharkhand or any other place. You cannot go there. How do you, and substantial transactions happen? How do you determine that? All of those business conditions, all of those concernings, which has an impact on the management should be looked at. Or for instance, you might have a situation where the company is incurring into losses. Now here is a parent company which says, listen, for the subsidiary, it's my child, and therefore I'm going to keep on giving you the comfort letter, I'm going to keep on funding it. But the fact of the matter is, you have got an ailing child, you got an ailing subsidiary. Does it going to doom the entire parent? From an accounting parlance, if you look at it, do you need to impair this investment? So therefore you can, or look at from impairment at an overall level. So these are some of the management consultations which you need to start looking at it very closely. And that is what you need to start discussing with those charged with governance. Relationships with IC, threats to independence, self-interest threats, self-review threats, advocacy threats, all of these are a part of the, the new code of ethics that is introduced in 2019. It's already there as a part of it. But look at from that perspective, from a code of ethics, how do you safeguard yourself? Now, From those independence perspective, you need to be very, very careful, because one of the key aspects of an auditor is to remain independent throughout. There are challenges. How do you do it? Now, you should not have a business relationship. None of your relatives should be employed in a very senior position. You should not trade in shares. You should not trade in this. There are various things that you cannot have. And therefore, how do you maintain that aspect? Becomes a very, very critical aspect. And if you have the larger organization, the larger is the influence that you need to start looking at. So therefore, what is important for all of us when we talk and deal with those charged with governance, it's important that is our discussions with those charged with governance is on internal controls. Are we looking at the efficiency and the accuracy of or the correctness of the financial reporting? Are we discussing about the compliance of laws and regulations? You could have GST law, you could have income tax, you could have shops and establishments, you could have pollution, you could have gratuity, you could have minimum wages act, you could have factories act, name any number. There are more than 4,000 acts which are there. Are we looking at those aspects of it? Are we looking at bonus act? Are we looking at gratuity act? Are we looking at actuarially? Are we looking at leave encashments? Are we looking at people who are going on long leaves? How does it accumulate? All of these could have a material impact, all of this. And also sometimes what you might know, you might come aware saying that there are certain things that could have impact. For instance, you're operating in a zone where some of the regulators have started implementing, let's say on a pollution, you're creating a highly pollution, so therefore you're creating a pollution charge. And that pollution charge could be such significant item, it could have impacted the company's profitability, but the company would say, listen, we have not received it, and therefore we will not include. It is contingency, we will fight it out. These are the matters which becomes very, very critical when you discuss with those charged with governance. So as discussed, what is important? A very clear way of communications. It should be a two-way street. It can't be one way. The manner in which you communicate is very, very important. The minuting is important. Even within the people, the teams which are involved should be there. It is just not the partner going and sitting and saying, I've discussed with this management and covered those charged with governance. I think it's a very, very critical aspect. As I said, as much as for the listed companies is easier, but for consideration with smaller entities, it's a very critical aspect. You have to direct it. You have to talk about the competency of some of the personnel who are operating the management. How much can we do it? And I think that's a very big question that we come up when we deal with smaller entities or private entities, because they are very closely held. But it's equally important for all of us to make sure that we are at that level. Communication with management, it should be ongoing, continuous basis. Before we communicate with those charged with governance, it's important for all of us as auditors to first discuss with the management, take them through all of these matters, discuss in detail, and then talk about issues which that can be addressed by the management or through internal audit functions or any other person that can be there. But communication is a critical aspect. Communication should be with the management. Management should be made aware of, because ultimately when you go back to the board or those charged with governance, you say, these are the issues that have come through and therefore this has to be implemented. The management would say, listen, these have never been discussed with us. Had we known, we would have corrected long back. And this is a typical story, even if they know it. It is important that you split this communication. You inform the management in advance that when you will communicate relating to what, keep reminding them as to what are the changes and how does it impact. And this is a very, very critical aspect of it. Other thing which is very, very important is, which is again, there's a clarity which is important by ICA that there's no communication we should make with the third parties. Our responsibility is only to those charged with governance or those with the parties. If you have to share only under regulatory requirement, the letter has to be written to the management. Based on their approval, only you can communicate with third parties. Now, in addition to all of these effective communications, you have to talk about matters resolved effectively, communicate previously communicated, and control environment, special audits. So this is the broader structure that you should look at it when you're communicating with, especially in written communication relating to that. And in written communication also you should bring about at what point in time you will have communication related to issue, at what point in time you will withdraw, at what point in time you might say these are critical issues which requires the management, the board, those charged with governance attention. These are some things which should start looking at very, very closely. And again, when you're dealing with a company, when you're dealing with those charged with governance, remember one thing, our reporting responsibility has got three folders. One is our opinion on the audit of financial statement. Two, our audit opinion on the internal control framework. Three is in respect of company's auditors report order 2020. Now look at all of these together. If you look at the CARO 2020, if you look at internal control, if you look at financial statement audit, all put together has somewhere linkage. So you might say an internal control has deficiency, right? Or internal control can have a significant deficiency. The moment if you say internal control has significant deficiency, where does it impact? Two aspects of it. It impacts your financial statements, and if there is a reporting requirement on CARO, it might impact CARO. When I come to reporting on internal control deficiency, I'll talk about. But CARO 2020, let me give you a simple example. The first item is in relation to fixed assets, which is whether property, plant, and equipment, whether the company is maintaining title deeds, whether it is in the name of the company, whether the company is in the process of carrying out as carried out verification as per the manner, whether there are any discrepancies and all of this. Now you come back and say in the report and say the company is in the process for years together, the process of carrying out physical verification. The company is in the process of updation of fixed asset register. Take for instance. You put a comment in the CARO 2020 saying that the company is in the process of updating fixed asset register. Simple statement. Look at from an internal control perspective. Internal control, what does it say? Every transaction that is initiated, processed, and accounted and entered is in a timely basis, right? Preparer, authorizer, recording, and all of this. So that means every voucher that is raised is goes through the initiation process. Every voucher, every process is approved, and everything is accounted on a timely basis. Now, when it comes to internal control, and if you say fixed asset register is not updated on a regular basis or not been updated, has the internal is there a deficiency in the control? If there is a deficiency in the control, how did you establish in a financial statement that there existence of fixed assets and then you have done a valuation relating or depreciation? You have to think through the entire thought process when you're reporting. It is just not in isolation. It has to be throughout. So their communication when you do, always remember, if you're saying it's a control deficiency, does it have an impact on the financial statement? It's a very, very critical aspect of it when you deal with control deficiency. In addition to auditors reporting, you should be open to those charged with governance, willingness to with those charged with governance, ability. All of these is what I've been talked about, but these are very, very critical. But the timing is very, very important. So in summary, when you look at those charged with governance, it is not an SA standard which only requires you to look at only communication, but there are many things which is included, whether it's your accounting policies, identification of accounting policies, significant timing of transactions, or the estimates on the SA 540. All of these are very, very critical when you deal with it. So please make sure management identification of accounting, management process of making accounting estimate, risk of management. Please discuss all of this with those charged with governance. It's a very, very important. Even if there are financial statements deficiencies, make sure that these deficiencies are discussed in detail with those charged with governance. So this was summary for those charged with governance. Let's look at it in terms of internal controls and the deficiency that has to be communicated. Now, internal controls or financial reporting has been in play for a couple of years now, and there has been a detailed guidance issued by the ICAI, and that forms the basis of our report whenever we are talking about internal controls. Again, Internal controls again is divided based on materiality, based upon deficiency, classification of deficiency, significant deficiency, and material weaknesses. Now, you need to be very careful between what is a significant deficiency, what is a deficiency, and what is a material weakness. Now, let me give you an example of a deficiency. So, for instance, you may have a bank reconciliation statement that has to be prepared on a monthly basis. And it has to be prepared for about 12 months. Now, let's say because of the absenteeism of the bank or the person in the treasury, that was not performed for 1 or 2 instances. But they were subsequently prepared at a subsequent month, and that was reviewed, approved by the CFO. This is a case of where you've established a control which should be operating. It's called a monthly control. So monthly control, a bank reconciliation is prepared on a timely basis. Now, you find that in 2 instances, they have not done. Therefore, the control in respect of 2 months have failed. So therefore, there is a deficiency in the control or the process. Does it impact? You might say it may not impact, but it is something that the company should look at alternatives. So in case if this person was not there, you need to have an alternative where therefore you may put a process. That's a deficiency. Now take the same instance that this bank reconciliation statements is not prepared for 12 months, but it is prepared at the end of the month, end of the year. End of the year, you find out and say that whilst we have not carried out, but we have done at the year end and made sure all of those are, there are no unadjusted items. So from a deficiency, this becomes a significant deficiency. That means you're required to do, even though you've covered it in the 12 months, but it's a significant deficiency because it is not operating at that level which has been designed. Let's take the third instance. Bank reconciliation is not prepared on a timely basis. There are significant material debits and credits which are unexplained. Okay. If you've got material debits and credits unexplained, what is the consequence? If you have debits in the bank, which is unexplained, that means it is forming part of BRS, but is not forming part of your books and records. Same is the case of unexplained credits. Now, what would happen because of this? This would result into what is called as, it could impact the financial statement. How does it impact the financial statement? The financial statements, if you were to look at it, if there are significant unexplained debits, there is every likelihood there is certain expenditure which should have been recorded or not recorded. And therefore, you might have an issue. You might say, listen, I've got my receivables, I've got the receivables, I've got the checks. I put that as checks in hand, or I put as a part of BRS item, right? But these checks were never deposited. It's still coming as part of it. It has gone away from debtors and sitting as part of my BRS. And this BR, had you restated to receivables, it would have resulted into provisioning that you should do it under the expected loss method, and therefore the profitability could have impacted, or the profits could have been impacted. And if it's material, that becomes a material weakness. And therefore, when you are looking at all of these, please remember one thing: prohibiting you to carry out sending out confirmations or not explaining the reconciliation. Books and records, subsidiary books are not tying up with the primary books. If you have all of these as a part of it, therefore you need to identify whether it's a deficiency, significant deficiency, or material weakness. And this is a very important aspect when you're dealing with SA61. And this is something where you need to communicate with those charged with accounting. It is not the responsibility of the internal auditor alone. It's because we are issuing an opinion on the internal control of financial reporting, therefore it becomes a very, very significant component aspect. So therefore, when you're dealing with those charged with governance, please have a section relating to the internal controls. For instance, you've got an IT system, and that IT system is not operating effectively. Everything is in SAP, not able to generate. Therefore, this is your general ledger, which I've got it. You please use it. If your IT SAP is not operating effectively, how are you ensuring that this information that has been processed by the same system can be accepted as valid? Therefore, you need to go and test that SAP environment to see still if the information that is produced, even though that has been taken into your Excel sheet or something else, whether the input, process, and output is appropriate, and there's no changes that are made in the design, no changes in any of the backend, there are no changes in any of the controls. All of these needs to be established as a part of the internal control. So as I said, you have got three types. A deficiency. Deficiency is where you will not be able to, is design implemented, where it may not necessarily prevent or detect a fraud, and they're on a timely basis. That's the way I explained to you with an example of a bank reconciliation statement. Right? Significant deficiency, again, a combination of deficiencies in internal control, which you believe that merits the attention of those charged with governance, and as material weakness is where you have a combination all of that, and then you need to have a reporting. Therefore, what is important? All significant deficiencies should mandatorily be report communicated with those charged with governance. It's a very, very important statement. You have to give it in writing that these are the significant deficiencies, and this is what the management is. Therefore, if you don't correct it, it could result and impact not only on this one, but also you may have to look at your auditor's report, whether you want to qualify there also. There could be other deficiencies which are of importance, but it requires the attention of the management to correct it on an ongoing basis, but it may not impact the financial statement. So therefore, you look at from that aspect. Because the reason why this is important is, whenever you give a deficiency reporting on significant deficiency, you have to first give the description of the deficiencies and the impact arising on. Where does it impact? Does it impact valuation? Does it impact existence? Does it impact any of the occurrence? Does it impact any of these processes in SOD conflicts and all of this? Is it an impact of fraud? What is it? You need to look at each of these assertions, whether it's at a profit and loss account state level, or is it at a balance sheet level, at what assertions you're looking at. Is it a valuation impact? What it is. And all of this becomes critical. And this happens especially in inventory valuations, let's say. The management keeps on changing. Somebody might say it's a weighted average, but they might say whenever the prices are right, they might move or to last in, first in, first out, and might say all the inventory is valued at the last price. When the prices are low and you've procured at a higher, you still use what is last in, first out, and still say it's a weighted average. So you need to be very, very careful as to how these controls are operating. And this is a very important. See, the controls will operate at cycle levels, which is your inventory cycle, your procurement cycle, your fixed asset cycle, your treasury cycle, your payroll cycle, your revenue cycle, cost. It will operate at that level. It also operates in the preparation of financial statements. How is this information produced? That is, how does the from a general subsidiary ledger to general ledger to trial balance to financial statement, how does the structure work? What is the process of this information and which is accurately captured? Does the company perform a bank reconciliation? Does the company do an impairment testing? Does the company do valuations of actual evaluation? Does the company do inventory evaluation appropriate? Does the company has got a process of evaluating the expected credit losses on an appropriate basis? All of these will form part of the controls that are there for the financial statement closing reporting process. When do you start? When do you complete? When do you do all of this? is what gets covered. Apart from the cycle controls, you also look at the financial statement controls. And all of those which are very, very critical is what you would need to report those charged with governance. Very important aspect of it relating to what are the things that you will discuss. Exceptions arising from the management, if for instance, misstatements that were not prevented by relevant controls, but the controls did not allow. So for instance, you have a password that has to be changed. And let's say this password has been changed by more than 5 people. And therefore, it could have a lapse of the controls, IT controls. But you might come back and do a check and say, hey, listen, maybe while this is being there, you've done a test to see if there are any overwriting something and something has not come through. That even though there is no deficiency or there is nothing arising out of the processing, there is still a deficiency at the input control. So you may want to look at it much more closely. Again, for smaller entities, while the management may not do it for smaller entities, but as an auditor's expectation perspective, you need to be very, very careful as to what are the controls that are operating at this level. And it becomes much more onerous on the CA firms or the practitioners to look at it, and you need to look at much more in detail in terms of how these controls are operating. Some of the examples of deficiencies is in relation to susceptibility to loss or fraud to an asset. Sometimes, the assets are still continuing, but they're not producing it. You're still saying that I've got a good receivables, but they're not recoverable. I may have a loan asset which is not recovered, neither my interest nor my this thing. I may have an issue. I may have a lot of these subjectivity and complexity used to estimate impairments of any assets or a subsidiaries or any of that. I may be exposed to many of these deficiencies. Look at some of these indicators in terms of deficiencies. Ineffectiveness of control environment is a significant deficiency. Management identification of material management fraud, which is not provided by the control, is a significant deficiency. If the management has not implemented a robust risk assessment process, if the management has not corrected any of the ineffective controls and their controls are not, the deficiencies have not been remediated as of that date, if there is no response to any risk that is associated with it, that means you don't get confirmation for the chargebacks, you don't get confirmations for the sales return, there have been significant sales return later on. All of these becomes a significant deficiency. And how do you do it? You need either you can do it has to be in writing, or you can do it in terms of your presentation as part of. You can include it as part of the management letter, but if there are significant deficiencies, it has to be communicated in written and to those charged with governance. Again, these are all based upon significant, wherever there are public interest entities, nature and size and complexity of entity, and the type of deficiencies that everyone has identified. One of the things which is very important for all of us is you may have done a great job in identifying deficiencies. So we said this is not there, that is not there, this is significant deficiencies. Now let's take a case of the bank reconciliation. You came back and said there is significant deficiency because the management is not preparing a bank reconciliation. Let's say in all of the unexplained debits and credits, you find those parties are related party transactions, are those parties which are non-existent. Tomorrow something happens to that file, to that bank, to the company. You might say, I have reported significant deficiencies and therefore I've qualified this. Responsibility does not rest there. Today they say, if this was significant deficiency, did you look at from a fraud perspective too? Because there could be evidence that this significant deficiency could have resulted into fraudulent transactions. For instance, inventory is not from the records, inventory is from physical. But if your purchases are not recorded on a timely basis, but the material has come, debit side you have not put, but you have put the credit side, profitability is high, and therefore you reported high to the bank, and therefore the company has drawn more funds from the bank, and therefore they have defrauded. From the fraud perspective, did you look at? This becomes a very, very critical aspect of it, especially when you are looking at SA 250, compliance to laws and regulations. Therefore, when you have got significant deficiencies, look at from a compliance perspective, I say 250 to see, does this impact, does it result into any fraud? That's a very, very critical aspect of it. And the other deficiency is what you might want to do it as part of disclosures. Put all of these contents in a written communications, and written communications are very, very important. You need to give the procedures that you performed, the area that you performed, what have you identified as a deficiency, the nature of deficiency, the account balance that is impacting, what is the requirement under law, what happens, does it result into fraud or not? All of it becomes the responsibility of the auditors when you're communicating with those charged with governance. This is what I had today in terms of this, and I'll give back 15 minutes for question and answers. I'll now hand over to the admin for Q&A. Thank you. Lalji, aapke.
Thank you so much, sir. Thank you so much.
If there are any questions and answers which are there, I'm more than happy to take it.
Yes, sir. Can you hear me, sir?
Yes, very much.
Thank you so much for such a detailed and wonderful deliberation on both the essays. Thoroughly, I have gained a lot through your deliberation. Sir, throughout your deliberation, now I have received certain questions. So if you permit, can I ask those questions, sir?
Please.
Sir, first question is relating to one case study type. The managing director had the possession and control of RC book and keys of 3 company cars and refused to return the same to the company. Despite requests from the other MD, after a shareholder raised the issue with the auditors, the cars were returned to the company. The auditors verified the possession and control only after the shareholders emailed and gave a clean report. What was the auditor's responsibility to communicate with Tcwg and ascertaining the factual position before issuing this report?
One of the responsibility of the directors is the safeguarding of assets, right? Now, if the responsibility of the directors was with safeguarding of assets, the auditor's responsibility is that every asset exists, right? Because one of the conditions of existence of that, how did we establish the existence of assets? The existence of assets is established based upon the title deed, the ownership, the possession, and all of this. Now, car is a very small example. I mean, we have got 3 cars, and if they've taken a car, they could be because of a dispute. Let's assume that the auditors have come across all of that. What they should have put is that the nature of, you may not want to put the nature of asset as car. You might say in respect of fixed assets, in respect of motor vehicles, in respect of these things, aggregating to 3, amounting to so much. The company does not have possession in relation to this, and therefore to this extent, the company does not have right towards this, and therefore it could have an impact in terms of your income. Now the question then comes back is, why did the managing director possess those cars? Is it because of a dispute that his salary has not been paid? Is it because that he has been suspended? Is it because of any of the disputes that happen? It's nothing to just alone the fixed assets of the car. It may cost, let's say, 30 lakhs, or it might be 50-50, assuming that a car is, let's say, 1.5 crore. So you need to look at from that perspective, existence. You need to talk about that in case if the amount is material, you need to bring it out in respect of the auditor's report. Other than that, you need to, those charged with governance, you will communicate the possession is not there, this is the amount involved, this is what it is. You may still bring that as a part of the notes that these are not forming part of the assets in the company's possession in the notes to accounts. Without, if it's not significant. If it is material and significant in the overall context, then you may probably want to bring it as part of your audit.
Yes. So is it appropriate to communicate our materiality to the company management or Tcwg?
So see, in some cases, the company, the auditor materiality is the responsibility of the auditors, right? He will not necessarily require to report what his materiality is, because ultimately materiality is a basis on which an auditor believes that is required, on which he has assessed that it could be a significant area, could be a revenue, could be a current assets, could be a profit after tax, could be any of those items. So he doesn't have to communicate to them, to those charged with governance or the management, because none of the management should be aware of it. But should the auditor, should the governance ask it, you might say that we have used a benchmark based upon accepted principles.
Yes, sir. So since the statute governing the auditing inevitably prescribes the person or persons who will be held responsible for compliance or non-compliance of responsibilities under the respective statute, should auditor go about discovering TCWG? Even if responsibilities are delegated to subordinate authorities by TCWG, will the auditor be exonerated by non-reporting or communicating to the person statutorily mandated for supervision?
So the question is, what is the nature of the delegation that has been brought?
Yes.
So if the nature of the delegation is such that it is not only to those people, but such report should be made available to those who have delegated it. So our exoneration is not to the extent of what it is. It should be covered, because who approves the board management letter, representation letter? You should include that information in the management representation and get it approved by the board of directors. So the one way to it, you have the responsibility still rests with us. It doesn't say I've reported to audit committee and therefore I'm exonerated from this. No. But if you believe that the matter is of such importance that where it is, even after reporting that there's no response, you may probably, the greatest asset that we have is our audit report. And that audit report is what we need to start looking at much more closely.
Yes. Sir, the external or internal auditors of listed companies should report only and only to the chairman and members of the auditing committee of the board of directors for all the issues, including auditors' remuneration, etc. So kindly elaborate on this, sir.
So the audit committee will have an audit committee chair, right? It's called the audit committee chair. All the issues relating to anything from appointment, remunerations, issues, discussions, approval is to the audit committee members, to the entire audit committee members. The audit committee members can deliberate it, but the reason why I'm saying is you identify someone with whom you discuss before the audit committee. It's called a pre-audit committee. So you discuss with those chair beforehand when you're presenting it in the audit committee. But the presentation by the all the issues should be discussed by the professional only with the audit committee members in the meeting that is. The only leeway which is very important for you is that if you want to establish a very good communication and implementations, you may brief the audit committee chair prior. It's called a pre-audit committee. And then you might, the pre-audit committee chair can brief those people and the basis on this, and the discussions is much more effective and the resolutions can. That's the whole background.
Yes, sir. So one member is seeking your advice regarding if the new auditor of a listed company have been appointed in the AGM held during last week of September 2022. So he is seeking advice. The timings of discussion by the newly appointed auditor with TCWG and with the audit committee for half-yearly reviews as on 30th September and subsequent quarters of the year-end results.
Okay, there's a very important point that comes to it. See, one of the aspects, while the appointment could have happened during the month of September, the audit proposal could have happened before that, because there is an AGM notice that would have gone through it.
Yes,
so therefore, it is important that, when you see, one of the things is when you're presenting to the audit committee, you should first have an understanding of the entity. Even before you give your consent that I want to accept it, you would have done a background check about the entity, about what it is. Therefore, what is important is that while it is you are doing it for the audit for the half year ended, September, it is important that you should engage with the company at the time when your name is proposed as in the board, by the board, and then it would be recommended to be adopted by the shareholders. So during that intervening period, you can have a discussion with the audit committee. After appointment, you can formalize that discussions. So it is the way you can do it is you may request the company from the time that you may not have sufficient time to undertake the audit during this period. Post the board meeting, you might do informally go and get an understanding of that. And after the AGM, you may get this approval and then start the formal discussions and formalize those. So the best way to do it is do it beforehand.
Fine. So what is the auditor's responsibility if the shareholders agreement has been entered into secretly?
Oh, I'm telling you, be very, very careful about this. When the shareholders enter secretly and do anything, happily they will go. But anything goes wrong, they'll go and fix the auditors. And I'm telling you, there are many such cases. Please remember one thing as an advice to all the professionals. If the shareholders agreement says 30th June should be your audited financial statement and the company is not ready for audited financial statement, get the consent of that investor who said that 30th June on record, and that's how you should do it. Otherwise, that person will drag the record and says, as per my agreement should be 30th, whereas the auditor has not put it, and therefore it's the auditor's responsibility. So never ever, this is like, it's a cat and monkey story.
Yes. Sir, auditors are appointed by the shareholders in case of corporate entities, and therefore our responsibility to report to the financial statement is only to the general body of shareholders. Tcwg are also appointed mostly by the shareholders. Communication with Tcwg is only to obtain the view of the Tcwg before auditor decides on the matter of forms opinion on content of the financial statement. Hence, communication with Tcwg cannot override requirement to the report auditor's opinion to the shareholders. So who are the appointing authority of the auditor? Auditor's opinion? Who are the appointing authority of the auditors? Sir?
So no, let's be. This is a paradox. This is a paradox question. Okay, and you'll have a paradox answer only. Who appoints whom?
Yes.
As the shareholders appoint auditors, there's a board of directors appoint. Invariably, majority of the cases, unless the auditor has been through, never in India that's happened where the auditors have been saying that it is, because majority is how they evaluate it. The board of directors through the consultation. See, we have got the legal structure which is devised under the Companies Act, and that's each one is supposed to play the role. Unfortunately, what happens is we cannot go to the shareholder and say these guys have done a fraud. It says you first discuss with those charged with the governance and then go to the government. It does not even say go to the shareholder. 143.12 says if there is any fraud which happens more than 1 crore, first discuss with those charged. If those people don't do anything, go to the Ministry of Corporate Affairs, and then that's how it goes through all of it. The shareholders are only for the sake of shareholders. But really speaking, but the shareholders can take us for any, because of the any suits and all that, which is now there available for class action suits which are available for the Companies Act. But the fundamental principle is we have responsibility to the small shareholder, not the board of directors alone. We should always think about the small shareholder on the street when we are issuing an audit. I think that's what my thought process, because no matter what you have is part of communication to those charged with governance. Think from that person who's put his hard-earned money in this company if you're auditing a listed company.
Yes. So last question. So whether an audit engagement letter needs to be signed only by the directors or can be signed by any CFO or CEO?
So the board of directors, who appoints the auditors? Board of directors. Board of directors have to authorize whether it will be CEO, company secretary, or MD, whoever it is. But the authorization has to be there. And that authorization resolution, you should have a copy.
Yes. Thank you so much, sir, for a wonderful deliberation, as well as you have justified with the deliberation, and you have given answers to all the queries of the members who have raised the queries. And thoroughly, I have gained a lot, and it was really very superb deliberation, sir, on both the standards, sir. Sir, on behalf of AASB of ICI, once again, I extend my heartiest thanks towards you for sparing your valuable time. And again, sir, acceding to our request on a very, very shorter notice, sir. So thank you so much, sir. Thank you so much.
This is my feeding. It's Mother CA. That's it. I'm here because of CA. So therefore, the institute is where I need to be there. Thank you so much.
Thank you, sir. Thank you, sir. Thank you. Namaste.